we are going to be talking about, is now the best time to buy Tesla stock? So I hope you guys enjoy it. If you guys get anything in value out of this video, hit that like button, subscribe to the channel. If you have any questions, let me know down in the comments. And if you want to learn more about investing, money management, trading, I do have a course that offers a whole bunch of fantastic lectures, quizzes, and there is a chat room. And you guys can sign up for less than a cup of coffee. So make sure you guys go click that link in the description so you guys can sign up or at least check it out. So now, answering that main question of should you buy Tesla stock? Let's jump into it. Roll that intro. Come on, let's go. Alrighty guys, so the first thing we're going to actually do is look at Tesla's stock chart. Looking at the stock chart, you'll notice that this past year has been very volatile. The year-to-date return on Tesla stock is actually down about 25%. So obviously, just from judging that, you could have two mindsets. The first mindset is, oh my gosh, this thing is a sinking ship. The second mindset is, okay, maybe I should buy some shares now that this thing is undervalued, right? We've gotten some sell-off. It's back down to affordable pricing. Those are the two mindsets that a lot of people have, and I'll tell you mine here in just a second. But just from looking at the chart, you'll notice a couple of things. It does have some resistance up here at about $379 a share. Every time we hit this price, we just get natural selling pressure in the stock. It hit it once, we got selling pressure again, and again. Selling pressure every single time. Now support, on the other hand, obviously we have several spots with some buying pressure. I think some of the strongest support is all the way down here at about $227. We've gotten a tendency to see a lot of buying pressure starting to take place there. It hit it once in here, and then every time all the way in here, we just had a lot of consolidation. And on top of that, we had a lot of buying pressure stepping in. Okay, looking at their last earnings report, we can go ahead and determine that the company brought in quite a bit of money. They brought in about $16.9 billion, which seems like a lot of money, but this was actually a miss on their earnings. So a lot of people and a lot of analysts thought they were going to bring in more. On top of that, if we go ahead and we look at the last major thing the company did, it was a 3-to-1 stock split. So this made it more affordable for people to invest. It didn't do anything inside the company. It just made their shares more affordable. On top of that, there is some things you have to understand. So right now, anytime you invest in a company, personally, I look at about 3 to 4 things. The first thing is the revenue. You want to invest in a company that's actually doing very well on revenue, hitting all of their numbers, or if not hitting them, becoming very close. On top of that, you want a company that's beating expectations, bringing in more revenue each and every quarter. And let me tell you, Tesla's revenue is up 41% this year, which is fantastic. That's very good. So even their last earnings, they did not perform as well. That's completely fine. Companies are going to go through hardships, especially right now with the type of economy we're in. People just aren't spending like they used to, but Tesla's more than just a electric car manufacturer. They're a data company. They own Tesla Solar. They're just more. They're the first company to really improve autonomous driving, and really they're the leader of the electric auto space. So right off the get-go, I think Tesla is doing very well. On top of that, they have about $18 billion in cash, which is quite a bit of cash because they only have about $2.8 billion in debt. So they have way more cash in hand than long-term debt, meaning if Tesla ever goes through a hard time, they have enough cash on hand to pay off that long-term debt and continue to invest in the company, grow it, and just grow the company, because you need money to grow. You need a reserve if the company ever goes through a hard time, and Tesla has that. One of the biggest things that a lot of people don't like about Tesla is the price to earnings. The price to earnings, don't get me wrong, is very high. It's at a 92. Comparing that to other growth stocks, one like Apple, with the price to earning that sits just over 20, this one's at a 92. So it's a lot higher, but on the flip side, it's a growth stock. Tesla is a company that's going to be more volatile. It's going to have a little more risk, but overall, it's going to have a little more reward. On top of that, personally, I think that anytime Tesla stock is below 120 on the price to earnings, that always represents a good opportunity to pick up a couple of shares because of how undervalued it is. On top of that, right now the RSI is sitting at a 50, so meaning it's not overvalued, but it's not undervalued. It's kind of sitting in this middle ground. But the beauty of Tesla for me, guys, I definitely think in the long run, in the next 2 to 5 years, we're going to be wishing we would have bought more shares under $300. I'm a huge believer in Tesla, in pretty much all the products and stuff that they have. And I think the best strategy, at least for me, is the strategy called dollar cost averaging. It's a great way to invest because you don't have to invest all at once. You don't have to put up a lump sum of money. You can invest on a weekly or a monthly basis into the stock. And the beauty of it is if this stock continues to go up, you're making money because you have shares. But the beauty of it is when it sells off just like it's done, you're averaging down that share. So once that stock recovers, you're making money because your average cost is so low. It works very, very well for high volatile, high growth stocks. A perfect stock or a perfect, example would be Tesla doing dollar cost averaging. So answering that question, right? Is it now the best time to buy? Personally, dollar cost averaging is that best strategy. If I was going to put up a one lump sum of 10, 20 grand, I would try to get it near and around this 237 price, because this has that natural buying pressure. And I understand that there's going to be a lot more buyers in here than at $300, and it's going to help push that price up. And I just think dollar cost averaging would be the best way to approach that, because we could have a little more sell off back down to here. And if you're investing now, you could get such a good average price if it sells off. But if this thing starts pushing up, you have shares to make money, guys. So that's kind of my opinion about that. Also, guys, it's going to be volatile. It's going to be, it's going to be risky. Keep it under 5% of your portfolio, meaning for every $100 you have invested into other stocks, assets, bonds, ETFs, put $5 into Tesla. And the reason why that is because it's going to be volatile. There's going to be a lot of ups and downs. It's going to help your account and portfolio become very, very stable when you do that. And if you're going heavy into this thing, your account's going to be very, very volatile. On top of that, if this thing continues to get pushed up, with some buying pressure, you always can buy more. So guys, that is it. I hope you guys enjoyed it. If you did, hit that like button, subscribe to the channel. If you have any questions, let me know down in the comments, and we'll see you guys tomorrow in another episode. Take care.